Hello, good afternoon, and welcome to MF Corner on CNBC TV18. I'm Vinnii Motiwala, and thank you so much for tuning in as always. Now, today we're going to be putting the spotlight on allocation of the bonuses you must have received. It's end of the year, everyone's receiving the bonuses. So, how would you allocate them to mutual funds if that's your strategy? Where should you be investing it? How should you be investing? Should it be SIP? Should it be lump sum? How much of your financial goals matter in this scenario as well? To talk to us about all of this, we have Tarun Birani joining in with us, who is the founder and CEO at TBNG Capital Advisors. Tarun, very good afternoon. Surely we have a lot of people cheering at the end of this year with, the bonuses that are coming in now in their salaries. So what are the key factors to start with that an investor should consider before deciding on how they should be allocating their annual bonuses?
Good afternoon, and thank you for having me here. Yes, it is a very happy topic to discuss. I think this is the time of the year with many of us are very happy with the way payouts we are receiving, and we are actively looking at how to make the most of it. Right. So I think coming to the factors investors should consider before deciding how to allocate their annual bonus, I feel money is money. Everything is same. So my first and most important suggestion is we should not get emotional about this part. We need to be completely unemotional. It is a money in the bank account, right? So we need to make sure that how we can align it best for our long-term goals and purpose, right? So again, I'm a very strong believer of aligning our goals in three buckets: safety bucket, stability bucket, and aspiration bucket, right? Safety bucket talks about ensuring that I don't want to be poorer than before. I need to have a strong contingency. Stability talks about building financial freedom, building, let's say, children future goal, or anything which is related to stability. And aspiration is more about getting that extra push, looking at more concentrated investment. So we need to figure out which bucket currently we need to invest in, whether it's safety, which is deficit right now for me. Again, this money can go in the safety corpus. If stability is weak for the freedom part, one can look at that. Again, a lot of things one can look at. If you are running a lot of high cost personal loans, my strong suggestion would be to first repay those personal loans, because this can really help you reduce your I think high cost loans you can repay. Second, one should look at ensuring that this money is going into rebalancing the portfolio. If your portfolio or your risk tolerance level is high on equity, but because of some situation you are sitting on low equity, it is a great time to increase your equity in the portfolio. Again, similarly for the debt portion also. So rebalancing again can be looked at actively.
Mhm.
I have seen one very large challenge at this time. Lot of left allocated people get into a lot of lifestyle inflationary structures where they end up buying a lot of unconscious lifestyle spending happens there. So investing creates that intentionality in us, right? So again, one can look at actively using this opportunity to make the most. And there are a lot of tax saving opportunities one has available, like ELSS, NPS, and all those structures. So maybe one can see how they want to realign with that.
Okay, surely interesting, right? Safety bet, stability bet, or your aspirational, depending on each of the pockets, you can look at moving there. But then, how should you invest this amount, right? Because you're receiving a lump sum amount. Is it better to invest this once and for all in a lump sum manner? Look at something like an STP plan, an SIP plan, or how should you go about with this?
Right. So again, this is a very evergreen question, and most of the time I get this question, and there is no straightforward answer to it. It again depends on two, three things. First is the market conditions where you are in. Is it undervalued, overvalued? Again, you need to have a matrix which should tell you that the current environment is conducive for equity investing, or it looks very overvalued, and you want to stagger your investor for a longer period. So let me talk about today's market. And again, I look at three, four large parameters like price to earning, price to book value, market cap to GDP, and yield gap, which gives me one matrix where current valuations are, and this tells me that we are in a neutral kind of market positioning right now. So in the current environment, I will take, say, another 6 to 8 months to deploy my money. I would not go lump sum today. I will try to use tools like STP, value investing strategies, to ensure my money goes in a smaller phase rather than investing lump sum, because market looks neutral or fairly priced to me today. Again, it depends on investor psychology also. I think some investors are high risk taker. They can look at lump sum investing, and investors who are, let's say, have a lower risk appetite can look at staggered investing. Again, the best part about staggering that money, it manages your behavior well. It gives you psychological reassurance, that creating that emotional discipline, right, which helps investor stay committed to the various market cycle, right? So but my practical thumb rule is, for recurring bonus, if you are expecting your bonus to be recurring under certain threshold, a lump sum might be a pragmatic thing, because if you are expecting monies to come on a stagger level, right? But if you are expecting a one-time amount, maybe a staggering and going for a STP SIP option is a better option.
Okay. And are there any specific mutual fund categories, like in equity also there are so many available? There's debt, there is hybrid, balanced advantage fund. What is more suitable for which kind of investors, and how should they go about it?
Okay. So I spoke about that safety, stability,
Yeah,
aspiration
right.
buckets, right? So one need to create their own financial plan, and based on that, they need to define which category of investment or mutual fund scheme could be most useful for them. But again, for lump sum investing, I think what I have observed from a rolling return data, asset allocation structures like balance advantage fund, multi-asset fund, equity savings fund, these are much better structure from a lump sum investing point of view. But again, and if you have a short-term goals, you can look at short duration debt funds. You can look at liquid funds and all that, to ensure safety and liquidity of the portfolio is there. But if you're really looking at long-term horizon, and you feel this, you can deploy this money for 10 years, I feel a staggered strategy, where currently putting the money in a low risk debt fund and staggering that money into high risk equity flexi cap strategy could be a very good thing to do, to make sure that you are mitigating that concentration risk and the growth opportunities taken.
Okay. Tarun, you're dealing with so many people, right? You advise everyone. What is the common mistake normally that you've seen with investors in such a situation? Or, they tend to do while they're deploying their bonuses into mutual funds? And anything you would advise them to for sure avoid? Like, this is the big red flag. Please do not do this.
So I think one of the very good question, and one of the largest mistake I have seen people do is, we all as human being react to the recent performance. I think we forgot what has happened at the COVID time. We forgot what has happened at the global financial crisis time. I think we are slaves of what we see in last 6 months, 3 months, 8 months, right? That is how the human brains are wired, right? And again, due to this, investor frequently chased past year winners instead of evaluating returns based on rolling return, which according to me is one of the best way to identify the best fund managers, and to identify their skill. But I think most of the time people look at last 1 year, 6 months, and maybe they land up into a best defense fund, best infrastructure fund, or a best thematic fund, which may or may not be useful for their long-term investing. So I think recent performance is one of the very large mistake, due to which I have seen long-term returns of investors get compromised. And again, you must have seen the data, right? Over a 10 year, 15 years, though investments have returned great return, but investor returns are low. It is because of we investing based on past performance, right? We don't look at long term, or we don't look at rolling data and our goals, financial goals, before investing.
True.
And ignoring asset allocation is also one of the largest mistake investor make. I have seen people invest money just randomly, just because their friends and families are investing somewhere, or for their without identify their financial goal, they randomly investing into it. So due to which most of the time bonuses amount pours. And if I look at 5 years, it is going in only equities, which amplify portfolio volatility.
Ah,
So always recalibrate towards your strategic asset allocation framework. What is the right framework? And maybe you want to invest based on that. And last, and one of the another mistake people do is overconfidence or neglecting rebalancing. I have seen people don't look at rebalancing seriously.
okay.
Maybe because we have seen last 15 years of secular rise in the market, but I think asset allocation rebalancing is very critical and it can give you a better long-term investing experience.
Okay, that's interesting. Surely important mistakes to avoid. How you should be going about is also what Tarun has spoken about before as well. What basket you want to invest in terms of your financial goals, whether it's safety, stability, or aspiration. And on the back of that, he's highlighted how you could go about investing as well. So that is on investing your bonuses. On that note, we're actually going to slip into a very short break, viewers. We'll come back and we will be discussing more in terms of global mutual funds, and that too through Gift City. How should you be going about that? Tarun will be continuing that conversation after the break. Welcome back to MF Corner on CNBC TV18. We still have with us Tarun Birani of TBNG Capital Advisors. Now we're going to shift focus and talk about investing in global mutual funds, and this is through Gift City. And what are the pros and cons of this? How should you actually go about this as well? Tarun, this is a very interesting topic. I just want to start by, helping our viewers understand one, how should they go about this? Gift City, what is that? How does it enable Indian investors to actually access global mutual funds or other international financial products? What is the process for this?
Sure. So Gift City, or the Gujarat International Finance High Tech City, is India's first operational international financial services center, similar to the concept of financial hubs like Singapore or Dubai. It essentially acts as a onshore offshore financial ecosystem, allowing Indian investors seamless access to international mutual fund, ETFs, or structured financial products. Again, just talking specifically for investors. What's unique in Gift City is it eliminates the traditional hurdles associated with global investing, like complex documentation, foreign currency transaction, and offshore account management, while it provides a regulatory oversight from India's IFCA. Again, IFSCA is the regulator which regulates the entire Gift City investor experience completely there.
Okay. Could you walk us through the step-by-step process for an Indian resident to invest in global funds via this, including account opening, and what is the regulatory requirement also that we have here?
Right. So, as we look at currently from the Indian investor point of view, RBI has put in restriction to the Indian mutual fund investor to invest into global mutual fund through the feeder fund route which we had available. So now Gift City is becoming a very attractive option. So there are two ways one can participate. So one is there is a need to invest outside India to diversify your money, right? So first route is you can open a broking account there. So you can select a IFSC platform, choose a IFSCA regulated platform or broker in Gift City, do the KYC like your typical PAN, Aadhaar, passport, and all that, or and sign a declaration under the LRS scheme. You need to open a IFSC account, which should be a open a. My suggestion would be to open a USD denominated bank and trading account with the authorized bank operating in Gift City. Then fund the account, and again, this there is a limit, not more than USD 250,000 per financial year from your regular bank account into that USD dominated Gift City account seamlessly, which converts your INR to USD. And after this, you can step five is to invest globally to all these international mutual fund, ETFs, US stocks, offshore bonds, or thematic global portfolio available on your platform. So this is one route through which you get access to all these portfolios by opening a broking account. Another route, which is again, we have seen a lot of launches happening, which is like the outbound funds. There are a lot of outbound funds which asset management companies are launching right now, and they invest into the portfolio mimicking the global funds, right? So that is another route if you're looking at a managed portfolio. But if you yourself has the skill set to pick up the best stock globally, or you can pick up a best ETF yourself, I think then you can go ahead and open a broking account. So these are the two routes available to Indian investor to participate in Gift City.
Okay, so you mean broking account, and if they're individually doing it, means I could go buy a stock in the US market on my own as well, like how I would buy in an Indian market. That's how it would work.
That's correct. That's correct. You
Okay.
need to open a broking account there.
Okay, so those are the options that are available and how you could actually start investing in the global markets and funds as well. Are there any taxes or tax advantages are there, or what is the taxation here? What is the flexibility in terms of repatriation as well as diversification? How does all that work as well?
Right. So first of all, you need to be aware that it will be under the LRS option, right? So any money which you get into LRS, you are subject to TCS. And for investment, there is a 20% TCS which is applicable. So let's say if you are investing $1 lakh, 20% of that you need to keep aside for TCS, which you can adjust against your tax commitments, like your advanced tax and TDS part. So that can be adjusted. That is the first part you need to be aware. Second, long-term capital gains investment more than 24 months are taxed attractively at to 12.5%. Additionally, there is a operational simplicity. Investor can avoid complexity around offshore account, foreign exchange conversion, and dual taxation. Furthermore, Gift City offers you easy capital repatriation under RBI LRS rules, removing the traditional liquidity hurdles. Essentially, it gives you a global diversification in a very transparent, regulated, and cost efficient manner.
Okay, surely that's the word coming in there in terms of the taxation point of view. What are the types of global mutual funds that are currently accessible through this Gift City? What are the plans in terms of the range of availability of products? What is the understanding there, right? Because your international funds, now you cannot normally invest through it. There's a limit, and it's reached that limit right now. So what are the options available there if I'm going through the mutual fund route?
So technically, right now, if you open a broking account gives you access to all the global ETFs, right? So US markets, whatever ETFs are available through the broking platform, with the likes of S&P 500, Nasdaq, and a lot of thematic like technology, healthcare, ESG strategies, multi-asset, fixed income, tracking treasury yields, all denominated in dollars kind of structures will be available through these broking platforms. Again, I have seen there are a lot of innovations and a lot of expansion of products happening there, where a lot of new ETF structure, a lot of fund structures, a lot of USD denominated PMS AIF are coming. So again, those are also in making as we talk right now. So I can see there would be a lot of options and opportunities available for investor going forward to invest outside India.
Okay, hoping, and we'll discuss more of these opportunities as and when they come as well. But what are the challenges or what are the risks that an investor should be aware about when you are investing, through Gift City into these funds, into the mutual funds, currency risk, regulatory changes? What are these that we are watching out for?
Right. So as you rightly said, one of the very largest risk investor need to be aware is currency volatility. ISD UNR exchange fluctuation can impact your investment returns significantly. So depreciation benefit returns, but appreciation of INR reduces your repatriate value. So that you need to be aware. Again, the liquidity and settlement cycles are not same as what is there in available in India. So international funds might take a longer settlement period, typically T+2 or T+3 days, possibly affecting your short-term liquidity planning. Again, regulatory evolution is also taking place where Gift City regulatory landscape overseen by IFCA is continuously evolving, making it important for investors and to be aware and updated regularly, because I think we are evolving as we talk. And again, tax compliance clarity. Again, we need to accurately report foreign holding annually. Errors on omission can trigger regulatory scrutiny. So that is also something we need to be very careful.
Okay, certainly a lot of points to be careful about as well, but an interesting opportunity that is shaping up for investors. So you have to keep the pros and cons and weigh them perfectly and then invest. But Tarun, thank you so much for joining in with us today, explaining us how to go about this process as well. So thanks for joining in with us on the show. And viewers, thank you so much as always for joining in with us on the show. And, don't go anywhere. Last 1 hour of trade is left. And to take you through that, we have closing bell up next.